What's up, Outliers? Happy Friday. The stream today is based on a series of conversations I've had over the last 2 weeks or so. I spend a lot of time talking about trading at a technical level at different levels, right? Sometimes simple stuff, sometimes more advanced stuff, and everything in between. I'm very quick to remind folks of the amount of effort that goes into trading, especially if you want to do this successfully. That effort is genuinely variable. The reason why I started the stream with the wait screen that I typically use on this is because of context. So I've been interviewed by Business Insider a couple times. None of these are sponsored. I've never paid to be interviewed anywhere. They just reached out and we had a couple conversations and we keep in touch now. But this is the thing that I want to highlight. And this isn't highlight this because it's talking about me. I really couldn't care less about that. When we talk about the work that goes into trading, sometimes if we spend too much time talking about just the work, we lose a little bit of sight of the payoff of what we're actually trying to do and what the target reward is for that. For me, it's that sentence right there, financially independent. That's what I cared about. So this, by the way, in case you're wondering where this photo is, I was actually flying a drone here. This is in Norway. We had found some fjord and did a little hike up the side of it, which was super cool. But if you get into fitness or dieting or anything like that, you will find that your progress really depends on your ability to embrace a near-term pain for a longer-term payoff. What that looks like, depending on what your goals are. For me, it's always been strength. I've never cared about how big I am, as long as you're not victim weight as a grown male, which is sub 200 pounds. That's a bare minimum. But don't be victim weight. But victim weight aside, I think your fitness goals are whatever you want them to be. If you go to the gym, when you go to the gym, you go work out for a day, you're going to notice absolutely nothing. You're going to notice nothing. You might feel good about going to the gym. That motivation will die over time, just like motivation typically dies over time in favor of discipline if you have it. So this is about delayed gratification. The entire concept of trading for a living is not trading just to do the work of trading. I've made it very clear, I am genuinely fascinated by markets. You hear me use that word, probably overuse that word on streams, but it is genuine. There's so many things that we look at on a daily basis that I'm truly fascinated by. Yet, if I couldn't make money doing this, it would be a much smaller part of my life. I still would probably try to trade a little bit here and there and do something in markets because I do find them interesting. But make no mistake, my initial involvement and the reason why it remains such a significant part of my life is because I make money doing it. And if it weren't for that fact, I wouldn't do what I do, period. So I want to start the stream today by helping connect these dots a little bit. I don't spend a lot of time talking about the benefit of trading or the takeaway of trading or what it can provide. And it's because I'm super cautious of that. I think a lot of people get into trading too far in the other mindset of get rich quick, hoping to make a bunch of money overnight. And my goal in general in my messaging is to just go polar opposite. Break that thought process, thought pattern, get rid of that because it's super dangerous to the individual, and focus on the process side of things. What I don't do is spend a lot of time talking about the eventual outcome of the process side of things. And again, it's for that relationship that I just described. I'm not going to spend a bunch of time talking about my outcome, right? That's really less interesting to me and less interesting to you. I want to talk more about your outcome and what trading can do. The reason why the channel is called the Outlier Trading Channel is because of the very fact that we acknowledge the reality of what this looks like for most people. So it's not going to be perfectly symmetrical. One, because I can't draw it perfectly symmetrical, but two, just because it naturally wouldn't be. But if I draw a bell curve and pretend that this is more symmetrical that it looks, and pretend it doesn't have like some sort of weird growth going on right there, just pretend you don't see that. And we break this down into standard deviations. So -1, +1, +2, -2. That's really all we care about. The overwhelming number of people that, and I want to talk about specifically trading, because in trading, this absolutely has both skew and kurtosis. Skew and kurtosis. This center point in respect to trading would be over here. Ish. With respect to investing, it would probably be over here. Because investing, it's way more difficult to like royally fuck that up. But for most people that invest, you're also not going to spend as much time over here in the significant outperformance bucket. So in the context of our community and what I try to espouse is being on this side. And it's not necessarily 2+, hopefully 2+ standard deviations, but definitely greater than 1 standard deviation. Greater than 1 standard deviation to the upside is still very, very possible. It's not super probable for a lot of people, but for those that truly do sit down and attempt to apply themselves, there's a decent percentage opportunity up here, right? So if we look between here, we have what, 68.2%, whatever. So we start in this bucket. As soon as we get out to 2 standard deviations, now we're talking 95.4%. So what that means is if you want to be better than 1 standard deviation inside this first bucket, there's like 13.6% that live here. Then you get into 2 standard deviations, which is like 2.1% lives in this bucket. So what I'm explaining to you is that this right tail of performance is accessible. We're not talking about the number of people that want to outperform 1 standard deviation to the upside being, 0.001%. That's not it. That's not it at all. This is not a terrible probability. So let's just call this 15.75%-ish to be above 1+, anything above 1+. So if you have 100 people, 15 3/4, maybe one of them is a midget, but still trades well. So they're just missing the rest of their height. That's where the 0.25 comes from. And if you take that 100 people, 15, 16 of them should be able to do this. The entire premise of the channel, the entire premise of my brand and what I focus on, outlier trading, is being this. It's being on this side of things. I'm not putting a task out here that is that crazy. If you think about the probabilities of being in something like a professional athlete, those are really, really rough probabilities. And it's because you also have to be born with certain physical traits. Even somebody that sees somebody like Muggsy Bogues, right? Small basketball player. Incredible, by the way. I actually used to look up to him a lot as a kid because I was smaller. My nickname is Smalls because of that. And I love basketball, by the way. So I used to see what he was able to do. And I was enamored, right? The guy was 5'3". Like, that's short compared to even normal people, not even basketball people. So in this scenario, we can see that there are anomalies that exist. But even in his scenario, even though he was not given the blessing or the trait of being tall, he was given a lot of other traits. He was very fast. He was agile. He was able to think quickly. It's not like he just found himself there. So if we take this back to a trading context, that system of traits is very different. And it's because it's not physical. What you're doing as a trader is not physical. I mean, sure, partially, but minimally so. So when you look at the performance potential for traders, you're not limited by something that you can't learn. Now, you are limited by just your cognitive capacity. There are going to be some people that literally just cannot grasp the concepts. That's okay. I remember when I was in, I don't know if it was undergrad or grad, and I was working on a couple like different stats projects. And I remember I got into this world where I just struggled with some of the aspects of what I was learning. For whatever reason, just didn't intuitively make sense to me. So like a lot of math in general, it took me a lot of time to like figure it out. But most of that stuff can be figured out. So let's talk about the reality of actually trading options successfully. We already know that without a doubt, it is going to be a pretty small probability of people that can do this. That's the reality. If you look at the different statistics on trader fallout rates, and again, brokers are very cautious to publish this, meaning they typically don't, but you'll hear anything around the ballpark of like 90, 95% of traders fail. There's some studies out there that are decent that give snapshots of this. But of this population that might attempt to trade, so let's say that there's 10,000 people in this sample that we're talking about. Actually, we'll just do 100 because it doesn't make a difference. Of this 100 people, how many of this cohort of 100 people do we think just naturally, based on traits, don't have the capacity to invest or trade? There's a subset, but that's probably like this subset, the -2, -3 plus standard deviation subset. For the group of people that literally just do not have any ability whatsoever to understand or learn this for whatever reason, you're probably in like the 2 to 5% range. Maybe. Again, I'm just ballparking, but it's definitely not going to be a big number. And it's because there's nothing that you have to do in trading that is just ridiculously taxing. It's not there. So we have this cohort that it's just not going to work. Unfortunately, just like if I wanted to go into a beauty pageant, it's just not going to fucking work. That's not where I'm going. It is what it is. It's okay. So hopefully this group can go find something else that they're really good at and can excel at. Just might not be trading. Then we have more or less the critical mass. The critical mass that attempt trading are the people that say, oh, I need $500 in the next 2 weeks because of blank reason. I'm going to try to trade it. That's the next major bucket of people. I have no idea how big that group is or versions of that group. I would feel very confident in assuming it is a majority. So I would ballpark that somewhere between 40 and 65%. I don't know in general, but I would say about there. Then we have the next cohort. The next cohort is probably the group of people that genuinely try and fail. They can genuinely try and fail due to a bunch of different things. They could genuinely try. They could spend time reading books. They could spend time trying different ideas, and it can just be the path of their returns. It can just be such a terrible path of returns due to circumstance that leads to failure. Again, hard to say how frequently that might be, but maybe 10%, something like that. I'm not positive, but this, again, minority of instances, but definitely possible. Then there's the group of people that really, really try and they're able to find some success. This group of people probably hovers around market return, might minorly underperform or outperform, likely underperforms net fees, that kind of grouping. And I don't know, maybe 20, 25%. Again, these are all guesses. I think the general relationships of these numbers are probably pretty close, but the actual metrics, I have no idea. So again, just continuing to reiterate that point, none of this should be cited. The main thing is the spirit of the conversation. Then there's another group of people that do this and they're really able to figure it out and kind of crush it. So for that, you might be talking again, like that 2 to 5% maybe. Going from this group to this group is possible, but improbable if you're actually applying yourself. The reason why there's people, the group in 10% that try and fail after like a legitimate effort, you have to have some pretty big process gaps in order for this to come to fruition. The reality is most people can go from this group to this group. Then the real game is going from this group to this group. So as I talk about the different things that go into trading, the different effort required, the different approaches required, sometimes I'll get different kinds of, it's not pushback onto me, it's more people pushing back, trying to shape reality into something that's more favorable to what they want. But it's just not the reality. So is it possible to start trading and be in this group? Easily. Is it possible to start trading and be in this group? Absolutely. If you just start YOLOing your account, you'll quickly fall in that group. That's easy to do. The real game, again, is ending up in these groups. So there's a lot of work that's required, but going back to what I was explaining at the beginning of the stream in trying to help contextualize this, the reason why this matters is because it's in this section that true life-changing wealth exists. True life-changing wealth. For this group, they will still be able to lead really great lives, especially compared to like the global population. They still would probably be in the top 5, 10% without a doubt. They're not going to be in the top 1% probably, unless they have correspondingly really, really good careers that they're able to aggressively save and grow. But without that, the probability of them hitting some sort of massive, massive amount of wealth is just unlikely. If we take a look at the distribution of the wealth, distribution of wealth in the US. I'm actually curious what's in here because I haven't looked. There's a couple things that I want to look at. What's this one? Statista? Look at these. This is from St. Louis Fed. And then this is another. Let's just see. Okay, well, this one I can't see. So share of net worth held by the top 0.01%, so the 99%. So as of late, that's like, I actually would have guessed this to be more. Kind of surprising. I guess maybe global. That's kind of a lot. So this is now in the US. This is more so what I care about for this. And this is over the last, looks like few years. Yeah, okay. So the top 1% are at like 28.5 trillion. So the first thing to note is if you take a look at the top 1%, which is essentially these green pieces, that is a immense amount of wealth for a very small amount of people. A very small amount of people. That's actually an absolute significant amount of wealth to be held by just the top 1%. So there's a lot of different reasons why that happens. I'm not going to go into some sort of big wealth class. I'm not qualified to do that. But we do know that there's different ways to create wealth. There's inheriting wealth, which I actually don't know how much this is accounted for by that. Then there's the people that create wealth through stuff like business. That's actually one of the more common modalities to create wealth. And then there's wealth through investing, stuff like this. Real estate is another fairly common one. So the majority of people here really don't have a lot going on. And I've shown a couple different versions of these statistics before, again, just for general context. This one is one that I go back to pretty regularly. So this is based on the US. And so the average income, I don't remember when I did this. It would be maybe 2 years ago. So call it 22, 23. The average income, 94, median, 74.5, average retirement, 61, average lifespan, 77. So the only thing I'm showing here is that the overwhelming majority of people spend the overwhelming majority of their life earning a really suboptimal amount of capital. And then they get to the ripe age of 61, at which point then they can retire, probably tired as fuck at that point, and might, if they're lucky, they go on to live another 16 years. Okay. Going back to the effort required to trade and why the effort, depending on where you're at, should be something that you openly embrace. Let's take a look at a couple different scenarios. Let's say that you have your money. Let's say that you've been working. Let's say that you've saved $50,000. For those in the chat, what age do you think it's reasonable to assume somebody might save $50,000? Legitimately curious. I have no idea like what the perception of that is. Kirk says 25. Okay. Level says 40. Lauren says 27. So right now I'm ballparking it at like 33. Sigma says 25 to 30. So I'm seeing late 20s is more dominant for sure. 3 votes there. And then I see 40 and 50 on the upside. So it looks like maybe like somewhere between like 30, 32, something like that. Based on just that general assumption, if you get to 50,000, depending on which age, I'm going to use a planning factor of like 30. Reggie says you folks don't have kids. Yeah, and that's definitely a part of it. To be honest, that's one of the things that had kept just my scenario going back and forth on kids and waiting to go that route. Kids definitely have an impact, but there's also plenty of people that have plenty of kids that can still sort it out. The biggest thing here, I think, is your earnings potential. Most people get into careers that just do not pay that much versus, again, embracing the delayed gratification of going into careers that offer way more upside. It's just the reality. So let's say you're at 50 grand and let's say that you're able, what do you think is a reasonable monthly contribution amount to save to an investing account if you're that 30-year-old that has $50,000? What guesses would we say? On a monthly basis, how much do we think that 30-year-old might be able? Level says 250. What else do we think? Jordan says 3K. Ignacio says 10% of income. So if income is 94K on average, that would be like $950. So we'll go with that. We'll go with 950. So you're able to save 950. We're starting this scenario being in your 30s. So we're going to give ourselves 20 years. You're still going to attempt to retire early. And in this attempt to retire early, you obviously have to do some research, do some analysis on how much you need. But I want to show you a couple different scenarios. The first scenario is, let's say that you take the average market return of 12%. You do nothing. You just continue to work. You save your money. Hopefully you can save more than $950 a month. I personally think that's very low, but I'm also skewed. But this isn't thinking about like saving now. I'm thinking what I did in my early 20s, and it was way more than that. But I went all in. It wasn't even just working one job. I was actually on active duty in the Marine Corps. But at that point, I was doing a bunch of other things to try and make money as fast as I could. Thinking of the wealth levers available to us that we talk about, there's 3 of them. And in the beginning, 2 of them are super, super important. So if we look at savings rate and investing and income, savings rate and income in the beginning are super, super important. Investing is something that you can turn on, start, let it run. So that being the case, we'll take a look at this 12% annual using regular stock market. That gets you to 1.3 million. For most people, that would be enough to retire. That objectively, for most people, is a really good path because the majority of people aren't retiring until they're at least 61. And they're not living on a lot in that scenario. In this context, starting, we're talking at 30 years old, you would be retiring at 50, 11 years earlier than the standard retiree. Objectively, a good scenario for most people. But let's take a look at a different scenario. Let's say that you're able to return 20%. Notice what just happened to that graph. The difference of an 8% return completely rips the graph apart. So at $50,000, saving just $950 a month, if you can go from 12% to 20% on average, your ending balance in 20 years is $22 million. That lives in that 8% variance over that duration. Everything else is the same. When we're talking about stuff like writing a trading plan, tracking your trades, building a trade log, analyzing your trade log, completing monthly AARs, all of that, every single piece of that is designed to attack that 8-point delta. That difference between standard market rate of return and then your value added rate of return potential. Think of the difference in these scenarios. The first and most important difference is, let's see when the account first crosses $1 million. The account first crosses $1 million 9 years in. Why does that $1 million matter? The reason why the $1 million matters is because in the scenario we're using, that's where the person would be conceivably financially free. So that means in scenario 1, they effectively would have to wait 20 years. In scenario 2, they cross that threshold 11 years earlier, 9 years in. So then from there, it's a game of what do you want? And how much do you want? And what do you care about? What do you value? It opens up a completely different world, but all of this stems from an 8-point variance in this scenario. Let's guide this down. Let's say 20%. That's record beating over long enough durations. That's incredibly good. So let's say at 15%. Notice the graph. If you get just 3% better, your ending amount here is $10.9 million. 10 times what you get in the other scenario. So what's the difference? What's the difference in performance here? 3 fucking points. So this is the question you have to ask yourself. Which of these scenarios do you want? And it's not which of these scenarios do you want in some ideal world. Of course, if I said bar none, everybody would want scenario 2. Say everything is the same, but one at 15%, one versus 12. Everybody would want scenario 2. The reality is, most people then start overlaying their preferences, their time, what they feel like doing. And then they get further and further away from that 15% reality. So in this broad nutshell, you have to decide, you have to make a decision which of these paths you are most interested in. And it's not interested, again, in the outcome. Of course, we'd be interested in this outcome, but it's interested in going through the effort to get to the outcome. Super, super important. And returning 15% per year is not crazy. That was my original target. That's why I used it here. When I first started this whole thing, my goal was to just consistently outperform the market average every year. And I didn't actually do that for quite some time. So if I look at the first year that I actually, well, I guess outperformed is relative because I technically outperformed in 2008. The market was down 37% and I was down 4.2%, but still lost money, right? Just way less than the market. It wasn't until, what year is this? 1, 2, 3, 4, 5, 6. Year 6 is when I actually beat the market to the upside. So this is where the decision is made. Which of these scenarios do you want? Based on your choice, it will then contextualize the rest of your choices. So when it comes down to sitting down and logging your trades, the act of sitting down and logging your trades is super unappealing. I'm not going to lie. It's not always appealing to me. But I always remind myself that the reason why I'm logging my trade and the reason why I'm staying supremely disciplined in doing this stuff is for this 3%. And if I hold on to that 3%, or if I even better outperform that 3% to the upside, the only thing that happens is I accelerate the timeline and I make more money. Both of those are positive outcomes. There's no net negative to me to outperform to the upside. I'm going to take a pause there. This is a little bit of a come to Jesus conversation, but the main thing that I wanted to use this for is an opportunity to talk a little bit about the output side of this. Because as I said, I do talk a lot about the work and effort, and it's to try to counteract the damage that's been done on social media by making money fast. I just made $5,000 this week on 60 seconds of work and all that bullshit that just literally damages people. So this is designed to connect the rest of those dots. It's to explain the why. For us in the military, we would call this the commander's intent. And the purpose of commander's intent is to give us an underlying scenario that we know we're working towards. So that then when you do sit down and you are faced with the question of, man, I don't want to log my trade. When that question comes up, you ask yourself, do I want 1 million in 9 years or do I want 1 million in 20? That same thought process starts cascading into other things this weekend. Do I want to go golf with the boys this weekend? Or maybe this weekend, I'm going to do something else that can generate income. Maybe you have another skill that you can consult on the weekends or some side hustles that you can get into or whatever. That doesn't mean you have to make the complete sacrifice, especially as you get older. I think it's important to have more and more balance. But for those that are younger, I think leaning as aggressively and heavily into the income generation saving rate side of things, you are way happier. And I use this example all the time. I've had multiple houses and now a bunch of other kinds of real estate. Most of my peers, meaning my age group, 34, people that I went to high school with, are literally just trying to buy their first house. That's their big goal. They're just trying to buy the first house. And I bought my first house in my mid-20s. So that's not to say anything negative about their scenario. Being able to buy a house even in your mid-30s genuinely is awesome. But there's a big difference. And a lot of that difference in outcome is based on the decisions that we made the decade prior. This holds true for your health. It's not like you wake up tomorrow with high cholesterol. High cholesterol is that result of a series of decisions that have existed for decades before that point. And then it culminates, and then you're met with a choice. Hopefully you make a healthy one. The main takeaway from this part of the conversation, at least, is to remember and acknowledge that the work that we're going through is for a purpose. It's for a very specific purpose. It's not work just to work. There is an outcome that we're pursuing. It's just not an immediate outcome, but it's still one that you can get. The more disciplined and rigid you are now, the faster that outcome comes to fruition. I just gave you an example here on the difference between 12 and 15%. Let's say instead of 15%, you get to 17%, 2 points greater. You cross your million threshold 10 years in, and then your ending threshold is like 14.5 million. This is where compounding gets really interesting, by the way. In case you didn't know, it's probably you could probably guess it. But once you're above $1 million, compounding becomes super interesting. And it's super powerful. But pre 1 million, it's still good, obviously, but it doesn't carry the same weight at all as compared to when you're post 1 million. So I think the first target is get to 1 million. If you get to 1 million, everything is, the wheels are moving in the correct direction at that point. Like you have a good thing set up. So I will take a pause. Malik says VA home loan difference. Using and getting the VA home loan is actually really, really solid. The major difference realistically is, at least for my first house, I didn't use it. Well, I used it to get a better rate. That's unfair to say, but I didn't use like the no money down. I put money down and it was standard. And it's just because I wanted a lower payment. So yeah, it definitely is a benefit for sure. But regardless of that benefit, I at least would have been in a spot to capture. Kirk says the variance should be smaller to add to estimate rate of return. The way you're doing it is just adding variance to the estimated return. I don't know what you're talking about. Oh, I see what you're saying. Oh, I'm an idiot. You're absolutely right. Dude, what am I doing? Thank you, Kirk. You're absolutely right. So I'm an idiot. I was literally saying 17% over this. So you have to be 29%. That's actually pretty good. Not gonna lie. That's pretty good. So I actually wanted to be like 10% over it. Thank you. So just to reorient us, just because I straight up screwed everybody up there, the variance is over this. So the main thing here is incremental changes in your performance have a cascading effect. What's even more important in this scenario, if you return 10% greater than the market, so hovering around that 20 threshold, that puts you at 1 million at 12 years. So you actually kind of see the first threshold really isn't that different. And that's just because of the impact of compounding. It's just the end threshold. The way to get to 1 million is about the same. You have to have a really big variance rate of return in order, just in significant outperformance to get to that 1 million way faster. But there is a really, really good way to get to this faster, way faster. The way we get to this 1 million way faster is by saving more. Let's say instead of $950, we save $1,500. Let's see what happens to that scenario. We cross the $1 million at 11 years. You take a year off and you're at 1092. So you essentially cut a year off by increasing that amount. The more you can jack this up, the more you slide all of this to the left. Like I said, the big difference you're going to experience really lives in the tails. So it's once you get to significant growth factors. So in this case, you cross $1 million at 14 years if you're at 15%. So you add 2 years on top of the original case that I was sharing where you'd be at 29. The big difference is what the terminal value is. So in this case, if you continue at that 15 rate, your terminal is only 2.6 versus the numbers I was sharing before. Completely wrong. But all of these numbers are still completely retirable. So let's take a look then at one other thing really, really fast. One of the most common methods that I see people talk about, like trying to live, is through selling premium. That's one of the absolute most common ways. There's a really big issue with it. And it's this: the actual post rate of return that you get on selling premium typically is not incredibly good. It's a little bit more stable generally, but if the goal is to try and compound, which it needs to be first, then focusing too much on selling slows that down. So if you have a developed account and you choose to sell to supplement income or just because you like it, that's okay. But the way I look at trying to create that significant change in your total wealth is focusing everything in your power on saving as much as you can and growing your income as much as you can. From there, it's just a function of how fast you get to different thresholds and then what your target returns are. Because let's say, for example, you want to make $10,000 a month post-tax. It's like pretty realistic. You can get to that pretty quick. And depending on where you live and that kind of stuff, you really don't need like a ton of money. Even something like if you want to make $25,000 a month post-tax, again, that's not like an insane amount of money. You need to make about $500,000 a year plus. So depending on your tax footprint. The choice is entirely up to you. Like the experience is up to you. What you focus on is up to you. How seriously you take all this is up to you. The good part is that in the beginning of your trading, it is way more about this and this than it is this. So what does that mean? You don't have to outperform the market massively your first few years. It's actually the opposite. You could outperform the market massively your first few years, and it actually doesn't really matter. What matters is, without a doubt, this, which is how much can you save? That's what matters. Kirk says, what account values are you thinking can make 10 to 25K per month? Yeah, I mean, I think if let's just work back, right? Let's say that you're able to consistently make 10% per year. If you want to make 25K and you're expecting to pay about half that, you need, like we were talking about, make about $500,000. So you would want around 5 million in that scenario to, at 10%, make that. And again, it's conservative. All of that's super conservative. You could certainly do that with less than that. But I think 5 million is it's a pretty fair way to look at it. The way I thought about this part of the equation is like this. If I brainstorm like a timeline of financial freedom, this is the first number that matters to me. And this number represents don't have to work. The don't have to work number is what I consider to be a minimal viable threshold. This is when could you coupon clip and ride share and aggressively budget, but unlock your own freedom. That's the first thing. After that financial freedom number, I believe the rest of this becomes much easier because you really do have your freedom at that point. You have a choice. Before that financial freedom number, you kind of don't have a choice. It's not quite like serfdom, but it's all not that far off. And it catches a lot of people because then you kind of just continue doing something that you don't really want to do, but you know you have to do it. So you just keep plugging away. Kind of shitty. So that's the first and most important number. And making the financial freedom number as low as reasonable. You have to be realistic. Like you can't say something like, oh, I wouldn't get health insurance because I'm pretty healthy, right? Like that's unreasonable. So it's picking a number that's as low as reasonable that you could reliably live a modest life. After that number, there's really the target number, whatever that target number looks like. And then there's just checkpoints along the way where you can ask yourself, this is a great flag. If it's Sunday and you're saying to yourself, I am dreading tomorrow, meaning Monday, the first day you go back to work, I'm dreading tomorrow. That's a fucking problem. That's when you start making a decision here. It doesn't necessarily mean that you're going to bail and not work, but maybe it means that you do take a structured risk and you go try to get a job somewhere else. You can accept that risk now. You're at financial freedom. You have the ability to support yourself in a lifestyle, again, that's modest. So you can take risks like that while still in pursuit of your target number, but try to do it in a way that you're not dreading pieces of your life. That has to be taken in context because there's always going to be shitty periods of life with whatever you work on, and you have to be able to get through that. You can't just like try to bail at each turn. But it is the kind of thing where if you consistently find yourself on Sunday night just sitting there thinking like, fuck. Or if it's like, if you have the Fridays, I actually hate when people are like, oh my God, happy Friday. Because I'm just like, that sucks for you. I really feel bad for somebody where it's like they're stoked it's Friday. That I understand it, but that's not a way to live if you apply yourself and want to create a different scenario for yourself. To be so happy about that day of the week simply because you're not working anymore, again, it's quite telling that you're working on stuff that you really, really don't care or don't enjoy or don't find value in. To do that for an entire lifespan, tricky. Again, it's all about decisions. Am I saying that that's not a good lifespan? No, I mean, that's completely good, right? Like if that's what you value and that's what you like and it helps provide for your family and that's what you're prioritizing and that's the best you could do at that time, it's great. That literally is great. But it doesn't have to be the reality. There are other paths, but it does require this kind of effort. So then let's talk about those two numbers, right? Let's talk about the 10K per month and then the 25K per month. The first thing that I already talked about that you have to take into a realistic consideration is taxes. And for this scenario, I'm literally just ballparking half, right? I'm just saying you're going to give up 50%. It's not going to be that for most people, but just starting with that as a scenario. That gives you a pretty good idea of what principal you need in order to return that based on your return performance. This number down here, what you're actually able to produce is going to directly dictate what your principal is. Yet, one thing that I hold very strongly is that the more conservative you set your scenario in order to continue this, you're going to be way more likely to succeed. And that actually leads to a funny conversation that I want to talk to you guys about real quick. I still regularly speak with my boy Benjamin, the dude from the Benjamin YouTube channel. He and I have stayed in touch literally for years now. And we talk about trading and how things are going and, all that kind of stuff. In the conversation, we discussed how trading's going because he's still refining some of the stuff he's working on. So we always just talk about like performance and stuff. I have found so far my absolute best trading years so far have been the last 3. The irony is the last 3 years is when I've had the most conservative return target out of any other year. Yet I'm massively outperforming pretty much definitely the average from any prior grouping of my trading career, which is 18 full years. I'm in my 19th now. I thought a lot about that. And I think there's a lot of irony in it, but I also think for somebody like me, a lot of it stems from a scarcity mindset, which I've talked to you guys about a while ago, because it's something that I acknowledge plagues me. It's just part of my psyche. It's part of who I am. I think, as I've mentioned before, that there are benefits with something like a scarcity mindset, specifically in my ability to execute the stuff I was talking about early on. Super reasonable to do that with the scarcity mindset. You're used to it. So the idea of like saving, buying stuff on sale, buying meat that just expired, but you don't care because it's 50, 80% off, right? Like all of those kind of things, no problem with that mindset. One of the reasons why I think my performance has really unlocked in the last 3 years, one is path. Market's been favorable. 2 is experience. I do think the more experience you accumulate in the business, the better you can recognize patterns, the better that you can adjust and make better decisions. But I also think that there is a reality behind the way that I'm sizing things. It used to be where once I hit my 15% threshold target, I would still try and pursue opportunities, but my base case was that 15% because I made this roadmap. I called it a millionaire roadmap, and it was going to get me to where I wanted to be before I was 30. It leaned heavily on my savings rate, but 15% is what I needed every single year at least. So that was what I was trying to hit. When I would hit it, my mind switched to being heavily focused on keeping it. I'm scared to miss it because if I miss it this year, that fucks up my entire timeline. So even though I would still try to take advantage of opportunities, and you guys all know, I literally do after action reviews every single month and a very deep one every year. So I can see clearly what was going on. The opportunities that I was pursuing or the way that I was trading fundamentally didn't change much, but I was sizing everything so conservatively. And it's because I didn't want to give up that 15%. I was terrified to fuck up my plan. So what's happened in the last 5, 8 years, somewhere in there, as I started hitting different kinds of financial freedom, once I hit this number, then I was comfortable. But then as I started hitting some of these other milestones, I started thinking like, oh, okay, like I'm pretty good here. So it was at that point that I start diversifying my investments to make sure that I have a robust plan, not just for me, but for my family. I am very cognizant of the fact that like if I die, Thor can't trade. He's not going to be clicking any buttons. So I'm planning for that. Hopefully doesn't happen, but it's a reality. So once all of that stuff was done, now as I see opportunities, I'm literally just sizing things as they make sense relative to the portfolio. I'm not super concerned that if I have some sort of drawdown or something that it's going to break anything, because it's not. So that evolution in mindset is really, really, really interesting to monitor and follow. But I noticed that that's been actually a really big part of the recent variance in my performance, is just a completely different methodology and mentality when it comes to sizing, not so much in execution. Execution and approach remains relatively the same, but I'm no longer scared or nervous about sizing things correct relative to the portfolio, because I'm not trying to cling on to getting that minimum return. The minimum return, as you all know, has actually been guided down massively the last few years. So just a really interesting mentality and like change in thought process. Pretty significant. Kirk says, is there a way to adjust the returns relative to market returns? Essentially, what is the alpha each year instead of actual return? Yeah, definitely could do that. There's no doubt. You could do that and focus on some sort of premium over whatever the market returns. That's completely doable. That's one approach. My approach was to make the game easier. The reason why I think this approach makes the game easier is because it takes the pressure off of any benchmark. The only benchmark I have is hitting this static one each year. More importantly, it captures a really, really effective method to outperform the market, which is this. I'll show you. This. So if you take a look at these different scenarios, portfolio 1, portfolio 2, portfolio 3. In portfolio 1, we have 10%, 10%, 2%, 10%, 5%. That gives us an average return of 7.4, compound annual growth rate 7.35. Portfolio 2, 10, 10, negative 5, 10, 5. 6% average. Portfolio 3, 30, negative 25, 12, 14, 12, average return is 8.6. So the strategy in portfolio 3 has a 1.2% better average return than portfolio 1, yet portfolio 1 outperforms portfolio 3. Why? Because it doesn't have a single down year. It has 2 single-digit up years, and every single up year here is lower than the lowest up year here. Yet, this 1 year of negative 25% completely derailed it. So this is how I thought about the problem set versus being even remotely concerned about what the market is doing. I focused way more on creating a setup that was supremely consistent and allowed me to leverage specifically the saving part to accelerate that upfront timeline. But all that summarized, can you instead adjust your return target to be relative to a benchmark? Of course. Yeah, you could do literally whatever you want. You could set up some sort of band if you prefer, plus or minus X% or Y%. That's cool. Completely cool. I went portfolio 1 route. That was my choice. And then again, going portfolio 3, but slightly outperforming. That's okay. It'll just have a different outcome longer term. So it kind of just, again, depends on the approach. Level says, what does aggressive trading literally look like versus conservative? I assume it's still the same profit mechanisms and strategies, but sort of different in portfolio diversification and allocation amount. That's exactly correct. Exactly correct. The other thing is in terms of overall portfolio risk. So let's say you set up your portfolio so that if there's a 15% shock downside in S&P, that you're still able to produce some sort of positive return, whatever. The sizing that you have to adhere to in that scenario is completely different than if you just accept drawdowns. So that's a big piece of the puzzle, I think, in terms of trading really conservatively. If you're trading really conservatively, you have to keep a lot of cash, especially with derivatives, because of the leverage. And that puts you in a compromised position for the majority of market instances where things just continue to slowly crawl to the upside. That is all in effect to avoid the drawdown. But there's an opportunity cost to avoiding the drawdown. And we can do the math on that. I did the math on that. And I found that the opportunity cost avoiding the drawdown is less than the drawdown itself. So I generally would just prefer to accept some level of a drawdown versus never having, some sort of drawdown. Or there's a lot of times, specifically in like coaching calls, for example, people say like, oh, I don't want to draw down more than 5%. It's like, there's literally nothing you can do. You can't even invest in bonds and get that. You have to go to a CD account or a money market account. People get so risk averse that actually becomes a normal thing where people are trying stuff like that. Having your cake and eating it too, which, fun fact, last night with my wife, I literally just changed my understanding. I never understood that saying because I always thought having your cake and eating it too, in order to eat your cake, you had to have had it. So doesn't that always happen? And she explained it to me. She's like, no, dumbass. It means you can't go through the enjoyment of eating it and then still have it. Like, didn't even occur to me, which is hilarious because that's an old saying. But there is no having your cake and eating it too in that context with the market. So if we're going to pursue some sort of more aggressive top line performance, you have to accept the trade-off to that, which often manifests. So yeah. Give me 1 second. Just got to pop the door. All right. Let me get caught up on the chat. Lauren says, that's where I'm at the moment, so afraid to mess up the gains, which isn't very much, but I'm so close to my first goal. I think for that, an easy way to help manage that is you can think of it in terms of how you set up your portfolio. That's what I do. I would make sure that my core allocation was going to get me to my target each year as reliably as I could and as much of that as I could. So that's trading things at the time like coverage triangles and ratio diagonals, because most market conditions you can get close to 15% per year on something like that. So for example, let's just price it really quick and see what it looks like right now with the market near all-time highs. So let's go to IWM. Pull this. And let's go to like a 35-day option. Let's go to like a 30 delta. 3.35. I think that's in here. Yeah, here. So 35 days. Strike is 239. Premium is 331. $239, 330. Oh, wondering. I was like, why is that? This hard coded. So it's like 19%. So that put by itself for that duration gets to a 19% annualized return. That target was made in conjunction with trying to come up with an analysis of like what was reasonable. So this is a good example of that 35-day option at the 239, which is a 30 delta, getting 331 annualizes out to 19%. So to be able to do that with the core allocation pretty conservatively in general was solid. So then as that kind of stuff is working, then what I'm doing is using the speculative allocation to try and take advantage of opportunities as they emerge and to try to accelerate those returns as much as I can. Because as the compounding effect becomes more profound, small variances in your return matter a whole lot. So, yeah. That's what I would think about, Lauren, is like, what is a way that you can get to a base return that would meaningfully progress you? That literally could be buy and hold an index ETF. That works for most people. Then using a smaller subset of the portfolio to aggressively try and do something productive and generate excess returns or something like that. Alan says, what's your Sharpe ratio if your target 15% CAGR? I have absolutely no idea. I don't care about Sharpe ratio. I don't care about Sortino ratio. That's honestly the cool part about being a retail trader. There is no volatility adjusted metric that I care about. It is all self-defined, meaning there's no imperative. There's no people that are putting money into the fund that if they see the money move too much, they get concerned and take the money out. I think those kind of metrics sometimes get bastardized by retail just because they see the professional side using it and then they start emphasizing that for themselves, which ultimately for a retail trader literally doesn't matter. I have strategies, individual strategies that have really good Sharpe ratios, but I can't scale them. So I can't, like, just because it has a really good vanity metric like a Sharpe ratio, as I try to scale it, then it starts to decline. Yet I can have really ratchet strategies that have terrible Sharpe ratios, but have good overall returns, which ultimately is the money that I withdraw from the account. I can't withdraw a Sharpe ratio. So I think it's good to be aware of them and it's good to track portfolio metrics like that. But I think it's super important to keep it in the context of what it is, which is a secondary metric. The primary metric in that scenario is what your portfolio is doing relative to your objectives, period. Then we can apply efficiency metrics and stuff like that to help see if we can gain more efficiency. But there isn't a scenario where I would take a 2-point haircut on my end of year return to increase my Sharpe ratio nominally. I wouldn't do that. The only scenario where it could make sense is if increasing the Sharpe ratio nominally would then allow leveraging it more. That's a different scenario. But I'm just talking in terms of like Sharpe ratio versus return. So, yeah. Anything else you guys want to talk about? This topic, I think, we don't spend a lot of time on it. And realistically, I'm not going to spend a lot of time on it. But I do think it's important to touch on it ever so often and make sure that we have a general understanding of why this kind of thing matters, what we're actually trying to accomplish, and the purpose of what we're doing. So yeah, my hope is at least it helps reinforce some of those primary points so that as we're looking and digesting the kind of effort and work that's going into our trading, we can at least contextualize to ourselves why we're doing it and how it directly impacts us. So yeah, Reese says, I'm great at saving. It's the income part that blows. That is a trick. I really think the best way to scale income, well, there's different professional decisions that you have to make in order for that to be the case. But beyond those professional decisions, I really think opening up more sources of income is the way. So that's finding any skill set that you have that you can do something and generate some sort of return on it. So, for example, stuff that I used to do, work on cars. I used to go fix people's cars, or I used to buy broken cars, fix them, sell them, stuff like that. I would find ways to overlap my interests with what I was doing to generate income, just because then it's just kind of like a symbiotic relationship. So I used to flip motorcycles, buy a motorcycle, ride it for a little bit if I thought it was a good market, got a good deal on it, and then sell it. Or over time, buy motorcycles as people are unwinding them in the winter and then sell them in the summer as everybody wanted motorcycles. So I would literally just have a mini motorcycle storage in my garage. There's a lot of little things like that you can do to make money, but those are just things that I found worked for me and my skill set and my background. The game for everybody is to just find, if you bake, find a way to sell what you bake. Find a way to go bake for somebody to help them on a weekend when they're doing catering. If you knit, find somebody that you can knit for, or knit something that people want and sell it on Etsy. There's a million ways to monetize whatever you're good at. And I think it's pretty much worth, especially new traders that are in the first decade of their trading career, it's entirely worth your time to get good at that. Because again, remember, a lot of traders in that first decade, they're like really, really focused on getting really good returns. But the funny thing is, your savings rate in the beginning really, really, really matters. It matters way more than if you have a 15% return on your $10,000 portfolio versus a 30% return. The nominal impact at those numbers literally doesn't matter. You would be far better off with the 15% return, but able to save another $500 a month from a side hustle. That matters way more. So part of that is keeping priorities in place. Then that will change. There will come a point where what you can save doesn't even hold a candle to what you can generate based on different percent returns. And then that's when you need to switch your effort. It's not a guessing game. It's literally a calculable decision-making process. So let's take a look at a quick scenario before we wrap up. Let's say we have two different strategies or two different scenarios. We have this $10,000 account, and let's say that we have two savings rates. Let's say we have one that saves $100 per month, one that saves $500 per month. And then let's say that we have 2% return scenarios. One is at 10%, one is at 10%, one is at 30%. So if we calculate this as a percent of the portfolio, the difference between these is massive. Saving 1% value of your portfolio versus saving 5%. But I want to show you a more important example. Next, let's say we then take a look at what your actual returns look like in these scenarios, which is the difference between $1,000 and $3,000. So what I'm showing you here is if you can save $500 in a month as compared to the $100, you're giving yourself a 5% return on your portfolio right here. 5% return on the portfolio as compared to the 1% return on the portfolio. Yet, if I break these down into monthly return targets, this is what they equate to on the portfolio. 83 and 250. So what does that mean? Literally, you are making way more here than here unequivocally. Let's take a look at another scenario. Let's say now you're at $100,000. What just happened? It completely flipped. At $100,000, that $500 represents half a point on the portfolio. That 10% return represents $833 per month as compared to the $500. At $100,000, you've just completely flipped. You are now better off spending the time, effort, energy on trading and getting a better return trading than you are spending the time, effort, energy on Etsy knitting sweaters for people. That's exactly what this means. So you can make this calculation for yourself. I literally just did it here with you. There's nothing magical, nothing crazy about it. It's just super straightforward. You just have to make it, because in the beginning, I will always remind you guys, you are way better off, literally way better off making more money. Even if it's not a whole lot in terms of what you think you're going to make trading, the probability of you making what you think you're going to make trading in the beginning is essentially none, meaning probably not going to happen. So you're way better off dedicating that effort to generating a guaranteed return on your portfolio, which again, on a $10,000 account, saving $500 a month is literally giving yourself a 5% return in a month on your portfolio. If you got a 30% return on the year, which is smashing it, it doesn't matter. The portfolio doesn't really care. So just keep that in mind. Reese says, you happen to have the most monetizable hobbies I've ever heard. Not really. I really think it's just a mindset. I think I can't think of really any hobby that you can't monetize in some way if you so choose. Even if you play something like fucking, what's that game where you paint the little figures and then you have a board game? I don't remember the name of it, but there's a fucking game that you can, paint little figurines and then you play the board game or whatever. It seems super random and obscure to me. But Wiggly Worm says Warhammer. Thank you. Warhammer. So you make figurines and then you fight them. Find a way to monetize that. Make figurines, make boards for people, host tournaments, and in that tournament, set it up where it's $20 to enter and then it's a 50-50 split. You keep 50% for organizing the event, and then whoever wins makes 50% of the pot, which is inevitably more than whatever they put in, right? It's just a mentality. There isn't anything that you can't monetize. You just have to focus and think about how you want to. Take the trading stuff. I am absolutely fascinated by markets. And fortunately, at this point, I'm not really doing this to make money, although I do make money from it, but it's not a good business model because I just invest it all back into the channel. But if I wanted to make money from this, and it's just another hobby that I have, I would set it up so that I would make money. it really isn't that crazy to think through and find the areas of whatever you like to do or whatever you're naturally good at and monetize them. But it is a decision. So, like, I can't think of anything that somebody might have as a hobby that you can't make a few $100s per month. A lot of times people just put themselves on too high of a pedestal in terms of like what they think they should get and shit like that, which is a disease. But that's what I'm saying. All right, gang, super fun conversation. I really hope that the context resonates and at least lights a little bit of a fire for you to start making some conscious decisions on how you want to approach things, because the money is there to be made. It's not going to be made by everybody, but you absolutely have the capacity to make it. And the coolest part about trading is there is no cap. There is no salary band. There's none of that. If you have a $1 million account and you make 10%, you make that $100,000. That's it. If you make 20%, 30%, it scales as such. So you are entirely the architect of your future. Be an outlier. See you guys later.